Thank you for taking time to watch this video. Law firms, like most businesses, want to know where they stand when it comes to profitability, and there are a lot of factors that need to be considered. The model we describe in this video lays these factors out in a clear and concise manner, helping your management team understand not only your firm's current profitability, but also helps them make decisions with the key information needed to optimize the firm's future profitability. To save your time, I will cut to the chase and tell you why you should care about this model. First, the model compares key factors influencing profitability based on your firm's specific rules to paint a clear picture of what is helping and hurting your profitability. Second, we can provide a way to measure not only the overall profitability of the firm, but also at every level of the firm's hierarchy. We break each measurement down to a per billable hour level, enabling comparison of business units of varying sizes on a level playing field. Take that a step further. If your firm is considering the acquisition of another firm, then we can build a model with both firms' data based on your business rules to understand exactly how the other firm's profitability compares to your own. The Timekeeper return on investment metric shows the profitability impact the types of cases your firm takes and how its billing and cash collection performance can significantly impact your profitability. We built a sample of the law firm profitability model, and one of the views within the profitability model allows for the comparison of business units within the firm. The example view compares the corporate and litigation departments. We wrote a process that allows us to allocate expenses down to every billable hour worked. We added an expense specific to the litigation department where they requested a legal research tool that only benefits their department. Note the entire expense is allocated to the litigation department. We can see that $6.18 of every hour of billed time in the past year was used to pay for the software. This understanding helps the management team figure out the impact of the expense, which can be weighed against its benefit. Also note the comparison of the timekeeper salaries and rent office expense lines. The average litigation department timekeeper salary per work hour is 18.7% higher than that of the corporate department, and the rent office expense is 38.6% higher than the corporate department's corresponding expenses. Without a view like this, it's difficult to determine how these expenses are affecting profitability. In this example, we go down the line to understand the profitability of two corporate billing attorneys. Partner D had 1,970 more billable hours worked on their cases than did Partner F. As a result, Partner D billed $2.4 million, which is $441K higher than Partner F, at a slightly higher billing realization. The purpose of the per work hour measure is to create a baseline that provides context where the size of business units vary. It shows us that not only has Partner D accumulated more billable hours, but they've also are averaging $5.24 more per hour in the amount billed. This provides a context to Partner D's 0.9% higher billing realization. While Partner D bills more, they are not very good at getting their clients to pay on time, while Partner F is very good at this. Law firms push hard at the end of their year to collect as much as possible. As a result, the executive leadership team sometimes authorizes write-offs that would not authorize at any other time of the year to push their clients to pay. Partner D was authorized to write off $436K to get their collections to $2 million, while Partner F brought in the same $2 million with only $22K in write-offs. Partner D's write-off represents $35.17 per billable work hour, while the write-offs associated with Partner F's are only $2.18. Partner D's payments received represents $166.91 per billable work hour versus $196.86 for Partner F. It's good both billing attorneys collected $2 million, but this information shows the Partner F did a much better job of getting full value out of the billable hours worked. The profitability model consistently evaluates the trailing 12 months to make sure that major events like the write-off are considered throughout the next 12 months. This helps all involved keep their focus on improving collections and avoiding a similar write-off the following year. The model also calculates WIP AR average balance over the past 13 months. WIP stands for work in progress and represents billable hours not yet invoiced, while AR stands for accounts receivable and represents billable hours that have been invoiced but are not yet paid. Understanding how much WIP AR is carried over the year helps us understand how well the firm is billing and collecting. The types of cases the firm engages in also affect how much WIP AR is carried throughout the year. For example, contingency cases require carrying the WIP AR until the case settles, while other types of cases may be billed and collected each month. Understanding your firm's case mix helps when evaluating the cost of capital and setting cash flow expectations across all of the work done by the firm in a fair and consistent manner. Partner D's WIP AR average balance is significantly higher than that of Partner F. This could be based on case mix, but given the fact that both are corporate billing attorneys as well as the write-off, it is more likely a symptom of Partner D's slow billing and collections. Partner D has $255K more in allocated expenses than that of Partner F, but if we look at the amount per billable hour, we can see that the variance is only $1.30 or 1.1%. The cost allocation method used is based on the billable amount, and because Partner D billed $441K more than Partner F, their allocation dollars are higher, but in the same ratio as those of Partner F. If we dig deeper, there may be out-of-range expenses between the two, but overall they tie, so it would not be the first place we would look for issues. Now we reach the profitability metrics, and the first metric is WIP AR turn. The way to read the metric is that the higher the number is, the better job they are doing of keeping the time between when work is done and when it is paid. That means Partner D has a much slower time frame from work date to payment date when compared to Partner F. The profit margin is calculated by taking the payments received and subtracting the total allocated costs. We can see that Partner F is nearly a 12% higher profit margin than that of Partner D. The profit margin number answers two questions. How much did we make based on the payments received, and how profitable were we? It does not answer the third important question when considering your return on investment, and that is, how much did we have to carry in WIP AR to bring in those payments? This is where the timekeeper return on investment comes in. The timekeeper return on investment is calculated two different ways. The first simply takes payments received and divides it by the average WIP AR, and the second subtracts allocated costs from the payments received before dividing the average WIP AR. We calculate the timekeeper return on investment with and without costs as separate metrics to make sure it's easier to see the effect of the cost on profitability. When all factors are considered, it shows there is a pretty big difference between the profitability of Partner F and Partner D. Partner D probably thinks we're picking on them at this point because this is yet another metric saying they're not doing very well. Let's do a variation of this view that brings Partner D's write-offs and payments received in proportion with that of Partner F to see how that affects their profitability and their timekeeper return on investment. First, we change the value of their write-off and payments per billable hour to the same proportionate rate as that of Partner F. We say that definitely helps bring their profit margin in line with that of Partner F, but the WIP AR turn and timekeeper return on investment values are still not very good. Why is this? Even though they're pretty close to equal from a profit margin standpoint, Partner D is still carrying a much higher average WIP AR balance. There is a cost associated with carrying high WIP AR balances, and this metric gives a clear understanding as to what that cost is, while also answering the original questions of how much did we sell and how profitably did we sell it. This is important because the best way to understand your firm's profitability is to make sure your answer considers all key factors. That is exactly what this metric does, making it easy to identify the areas that are helping and hurting your profitability and addressing them accordingly. We can set up any number of views in whatever format makes sense for your firm. In our sample model, we created 3 basic views. First view breaks the information down by practice area, billing attorney, and associate. The second area is by office, billing attorney, and by client. Lastly, as we've discussed throughout this video, we set up a view that allows you to look at two areas or business units in comparison. And we set it up, let's do this one as an example of the Miami office versus the West Palm Beach office for real estate only. While we create versions of the report that use end-of-month or year-to-date timeframes, trailing 12 months, abbreviated as TTM, is the timeframe primarily utilized. This is done to smooth out the peaks and valleys of billing, cash collections, and expenses that occur throughout the year. The first two columns give the billable hours and billing utilization. Billing utilization is calculated by taking the number of billable hours worked divided by an 8-hour workday. If a timekeeper enters 10 billable hours in a workday, then their billing utilization is 125%. As with the expense allocations, we take the calculation a step further. You'll note that we are able to calculate utilization at a client level. We were able to do this because we calculate each individual workday by the clients the timekeeper worked on that day. That means if a timekeeper worked 10 billable hours in a day, and 5 of the billable hours were on a specific client, then 50% of the workday hours were allocated to that client for the timekeeper. Note that each of the clients associate S had in the one-day example below have the same billing utilization. The benefit of this approach is when aggregating the trailing 12 months, we can calculate the billing utilization rates by client or by any level throughout the firm's hierarchy. The billable amount column has the amount that could be billed, and next to that are the discounts taken at the time of invoicing the client, and the billed amount is what we actually invoice the client. The billing realization is calculated by dividing the billed amount by the billable amount. Note the client highlighted in red has a billable amount, but no amount in the billed amount. This is because it is a contingency case that will not be billed until the case is complete. Also, the two clients highlighted in green have a higher amount for the billed amount than the billable amount. This happens when either billable hours were worked outside of the trailing 12 months, or if a case is settled for an amount higher than the billable amount. The write-offs amount column has any amount that is discounted on billed invoices, and the payments column has all payments received in the trailing 12 months. Next are disbursements. The incurred column has all disbursements incurred in the last 12 months. Discounts are any amount discounted prior to invoicing, and payments are payments received. We also split out the disbursements by hard and soft disbursements. Hard disbursements are a true cost incurred and paid to a vendor on behalf of the client and billed back to them. An example would be court filing fees or expert witness fees. Soft disbursements are a law firm cost not paid to a vendor but still billed back to the client. An example of this would be work done by the word processing department. The distinction between disbursement types is important because it's a huge red flag when hard costs are discounted. It's not good when soft costs are discounted either, but it's more acceptable. We had partner F discounting all of the word processing fees as an example. Next, we have the average WIP and AR balances broken down by fees as well as hard and soft disbursements. This is important because later we'll show you how the hard and soft disbursements can be filtered out separately when it comes to the metrics. The allocated cost can be expanded to show expense account groupings. We have a script that allocates each expense down to the lowest level of the firm's hierarchy pro rata based on billable amount. In this example, we will show how the West Palm Beach rent expense is allocated to the West Palm Beach timekeepers. The billable amount of $360,151 for Associate N accounts for 5.492% of the total billable amount of $6.5 million. The West Palm Beach rent expense total is $304,938, which means Associate N is allocated 5.492% of the rent expense, which is $16,747. You will also note that we split that amount by client so that we can produce a P&L statement at all levels of the firm hierarchy with this expense included. Next are the profitability metrics. As with the profitability comparison view, we have the profit margin, dollars, and percent, as well as timekeeper return on investment with and without allocated costs, as well as the WIP AR turn. A key difference in the practice area and office views are the filters on the right. They allow the user to filter out disbursements or costs, and those filters also affect the calculations related to the profitability metrics. As an example, I'll go ahead and split out the disbursements. So first we'll go to the hard and soft disbursements for the payments, and we'll also take a look at the WIP average disbursements, hard and soft. If we go to the right, you'll see that when we turned off the hard disbursements, the amount went to 0 here, and you'll also see in the payments the amount went to 0 there. If we do the same thing for the soft disbursements, you'll see that the amount in the average WIP went to 0, and you'll see the payment amount for the disbursements also went to 0. Then if we move to the costs, each of the costs as you go can be excluded. And you note that not only do the amounts over here go to 0, but you see that the calculations also change. And it's just as easy to take them out or to add them back in. The slicers can be used in a very similar way. With those, you can go ahead and choose a specific area. So in this example, we'll choose real estate. And once that's chosen, all of the numbers you see to the left will be related specifically to real estate. And also, the only associates that will show undimmed are going to be the ones that actually have data related to the real estate department. And if you want to take a filter off, it's just as simple to click it off. We also provide detail level reporting behind each number to help your team with researching any number they don't understand. As a sample, here's the timekeeper balance detail report that shows the month work is done, when work is billed, when payment is received, and the cumulative balance of unbilled time and the WIP AR balance by month. You will also see in the detail sheet that each value is stored at the customer, location, practice area, billing attorney, and timekeeper level to allow aggregation in whatever way the firm needs for analysis. We've written several detailed articles related to the law firm profitability model. You should be able to find the links in the comments section of this video, or you can go to the Enright McPherran website. To get to the articles, you'll scroll down on the front page. And the first article written was the prologue. That's basically the elevator pitch where it just gives you a brief introduction to what the application is. Part 1 tells you the outline of how the profitability model is built. Part 2 relates to cost allocations, and the last part is how you actually utilize the model. To get to each article, all you have to do is click on the Learn More, and it'll open up the page within LinkedIn, and then go ahead and click on the title, and that will take you to the article. Also, if you want to take a look at the glossary of terms, just go to Services, Find Out More, and then the Law Firm Glossary of Terms, which gives you all of the terminology that we use within the articles. And if you're ready to contact us, either to get a copy of the sample law firm profitability model or to request a meeting with us, just go to the Contact Us page and leave us your information, and we'll get back to you within 24 to 48 hours. Thank you for taking the time to watch this video. We look forward to hearing from you and putting this model to work for your firm.